the highest level at R&B, we divide the investment universe into 4 categories: fixed income, or bonds, equities, real assets, and absolute return. Fixed income provides capital preservation and income, and we think about equities on a global basis, both public and private. Real assets are designed to produce a total return, but are also very inflation sensitive. And absolute return strategies are uncorrelated to the rest of a client's portfolio. So if we were to think about those different asset classes as vehicles on the road, bonds would be kind of like a truck, very stable, slow moving, and safe. Equities might be more like a sports car, where they're a little bit flashier, they can go a lot faster, but they're also prone to crash from time to time. Absolute return might be more like a bicycle. Not the fastest thing on the road, but when there are traffic jams, it can continue to kind of weave in and out and still get to where it needs to go. Absolute return investments are designed to be uncorrelated to the other parts of a client's portfolio. For the first 3 asset classes, a lot of their return is driven by macroeconomic factors. Fixed income investments are driven by and large by the direction of interest rates. With equities, a large portion of the return is driven by the direction of the market. Real assets are very inflation sensitive, so in periods of declining inflation, they'll struggle to generate a positive return. Absolute return investments are not driven by those 3 factors. They're driven by the design of the strategy and the skill of the manager. So when the rest of a client's portfolio faces one of those macroeconomic headwinds, absolute return investments should still be able to produce adequate return. One classic absolute return strategy is merger arbitrage. In merger arbitrage, one company agrees to buy another company at a set price, and immediately the stock of the company that's being acquired trades up very close to that price, but not all the way. And the reason it doesn't trade all the way to that price is because there's a risk that the deal doesn't go through. So a merger arbitrage strategy goes out and buys that company after the deal's been announced, and then waits for the deal to close and earns that small gap between the price that they bought it at and the price the deal ultimately closes. Whether interest rates go up or down, or whether the equity markets go up or down, don't really matter. All that matters is that that deal closes. There is a risk that it won't, but it's uncorrelated to other parts of a client's portfolio. At R&B, we spend a lot of time analyzing financial markets, analyzing the economy, and we have views on what the future will bring, but the future is inherently unknowable. We have to position our portfolios to acknowledge that a range of outcomes is possible. Owning just a mixture of stocks and bonds is not as well of a diversified portfolio as one that includes an absolute return investment. And the reason is the lack of correlation. You could have periods where stocks go up and bonds go up, or stocks go down and bonds go down, and absolute return strategies will perform differently, providing a smoother ride for the investor. To go back to our earlier metaphor, we think that while other asset classes will get stuck in traffic, facing a variety of macroeconomic headwinds, absolute return has the ability to weave in and out of that traffic and continue to produce an adequate return, despite some of the headwinds that other asset classes are facing.